Welcome to tonight's live stream where we discuss the one big beautiful tax bill. We're going to call it the new tax bill for sake of not messing up the alliteration. So we have Ed Rossi, we have Nicole Riney, we have Janice Witten, all certified financial planner professionals, and we're here to help you understand the one big beautiful tax bill, last time I'm going to say it, and how it impacts you and your retirement, because that's what you want to know, and that's why you've tuned in tonight. So a couple house cleaning items or housekeeping items first. We're going to do 2 raffles tonight. We are offering, if you register for the raffle, a tax guide to the new tax legislation, the new tax bill, otherwise known as one big beautiful bill. Last time I say it, for sure.
You can go
OBBB.
HR1.
Let's start counting.
So in order to qualify, you have to register, and you will receive that guide to the OBBB and $100 gift card to your favorite restaurant. So we're going to do that 2 times. The first one will be halfway through. The second one will be towards the end of tonight's program. And finally, we want to make sure this is interactive. So if you have questions, please enter them into the text box here. It's about a 40-50% chance we'll actually know the answers, but we're going to give it our best effort. In all,
vote of confidence.
Yeah, in all seriousness, we're still digesting this. There are a lot of moving parts. Relatively speaking, I forget how big. I'm thinking back to like the stimulus bill back in the Obama years, and then the Affordable Care Act, and then the American Rescue Act, and the Inflation Reduction Act. All these different pieces of legislation usually are thousands of pages. So this one did come in under 1,000 pages. So we have that working for us. But
So
in all
when
honesty,
can we expect the rest of the pages to come out?
yeah. Well, yeah. So I'm sure there'll be some amendments and some corrections to things that are in there, maybe not precisely spelled out as far as the impact throughout the rest of the bureaucracy within the government. But for now, we're dealing with an under 1,000-page bill, but it's still 1,000 pages, and the tax code is tremendously complex. So the ripple effects of this new tax bill are wide, and they are impactful, and they are going to determine how much income you keep and how much potentially still goes to the government. So we're going to cover the they have now told me I cannot call it the Social Security deduction, and Ed will explain why in a little bit here. But the impact on if you're on the Affordable Care Act, or if you're receiving a plan, either a gold plan, a silver plan, a bronze plan, you are impacted by this new tax legislation. If you have property, state and local taxes, the SALT deduction, that impacts you with this new tax legislation. If you're in retirement, if you're approaching retirement, making the right decisions now and preparing for how these things may impact you or will impact you in retirement, tremendously consequential. It means keeping more money in your pocket or giving more money to the government. So we're going to get into all of that, plus a lot more tonight, but we do want your questions. So it's an interactive live stream. Let me see who we have here real quick before I throw the first question out and we get going. Scott Paul says, howdy, glad to be here.
Hey, Scott.
Hi,
Scott? You guys both know Scott?
Nope.
No?
That'd be me.
Just being friendly.
Okay, we have Mike Cashola.
Oh, that's
Mike, how you doing? Did we get your video to you yet, Mike? Did we get Mike's video yet?
I think we did.
Okay, Mike, let us know. Let me know if we got your video. I told you we were going to get you your video.
And how many tears you cried while you watched it.
Yes. It's a great story. So, Mike had a retirement. Mike, I guess.
You're going to share it regardless. He's retired.
Happy retiring, Mike.
We celebrated.
We had a great party for Mike and his retirement, and we were able to record it. And we had a special time there. So, yep. So, okay, Mike, let me know if you didn't get that video. I hope you did receive it by now. Dwayne's here, Dwayne Westner. We have JT Johnson from Cyprus. And we have Eric Autry and Steve Sargent.
Welcome.
Okay, Steve Sargent. Wide receiver, Seahawks, possibly?
There's always a possibility.
Always is a possibility. Okay, Ed, so you sit on appointments with clients all day, as well as Nicole and Janice here. What's the number one question that you're receiving about this the government has labeled it a Social Security tax deduction, and their original intention, at least President Trump on the campaign, said they wanted to make Social Security benefits tax-free for all Americans. They were unable to get that through in this legislation because of the cost, but they...
How's that for timing?
We have a fire alarm.
Yay.
Hey, that's all right.
So
We
they
will
were...
persevere.
Not distracting at all.
No, not at all.
So I hope this doesn't go off.
Yeah.
So they were able to actually get through the $6,000. They call it a Social Security deduction, but it's actually they're calling it now a senior bonus deduction. What's the number one question that you get?
Since most of our retirees are close to, and we run the gamut from 50 on up to, one of my clients is now in his 80s, but for them is, there's some large deduction that I might be able to take advantage of. Do I get it? How does it work? And what are the limitations? And so there's a lot of confusion behind it, I have found, because it is literally a bonus deduction. It goes on top of the other deductions that if you're 65 or older, you are qualified for that. You qualify for this one as well. You don't have to worry about if you itemize or take the standard deduction. On top of that, you have to be cognizant because there are phase outs to where it starts to go away if your adjusted gross income starts to increase. So you have to be cognizant of that. It's going to sunset. It goes into effect in 2025 and will expire unless Congress decides to extend it. We'll see. That's another election type question, so I'm not going to go down that road. But it will expire or sunset in 2028. So that's definitely the number one that I'm seeing, because it's right now, if my numbers are correct, if you're 2025 married filing jointly, you're 31.5 with the standard deduction and the
previous bonus
that's if you would call it the first bonus deduction. And now they've added this one an additional 12 on top of that. So now you're at 46.7. And how you want to look at that is whatever your income is, the government's basically telling you of your income, $46,700 is tax-free. And then from that, they start to place your income into the tax table. So that's definitely the number one question.
Yeah, so whenever we go through numbers, we want to slow down a little bit and make sure you understand. So the current, if you're married filing jointly, your current standard deduction, because you have a choice, and many of you maybe used to itemize your deductions on your tax returns. A lot of you have always taken the standard deduction. But now, or at least going back to the 2017 Tax Cuts and Jobs Act, what President Trump did and Congress, they increased the standard deduction to make it more simple so you don't have to worry about keeping track of different expenses and possibly itemizing. And so what they've done is they've extended that, but now we also have, I guess what we have had, the bonus deduction. Is that what they called it? The bonus deduction?
Depending upon senior bonus
Well, not
deduction.
this one, the one before. So it's
First
if you're
65
single.
plus additional deduction.
Yeah, the additional deduction. So if you're single, it's an additional $2,000 if you're over the age of 65. If you're married filing jointly, it's $1,600 per spouse, so $3,200. So Ed's pointing out that if you take the standard deduction, if you do not itemize, your base standard deduction is $31,500. Then you have the additional standard deduction for being above the age of 65 of $3,200. Then, since you're married filing jointly, it is $6,000 and $6,000, another $12,000 on top of that. And just to break this down very, very simply, let's say you make $50,000 in retirement. Now you're 65 plus, you get to deduct $46,700 of that. So that means you only have $3,300 of taxable income, which would make your income tax zero. So, and if you're single, it's $23,750 is your total deduction if you're over the age of 65. So people want to know essentially, how much is this deduction? How does it impact me? And how much am I going to save? So, Nicole, you and I were kind of talking about this before, and we were talking about the effective or marginal tax rate with deductions. So, with a lot of the tax analyses that you'll run, sitting with clients, I know this just happened, and I know we're just starting to have people come in for quarterly reviews, for annual reviews. But are you starting to see, have you been running any comparative analysis from 2024 to now with this new tax law?
Oh yeah, absolutely. And that's something that I'm going to continue to do as, every year it seems like there's another level of this bill that's going to come into effect. But one key thing to keep in mind is that that doesn't have any impact on like your AGI, right? So all these numbers are still going to count towards your Medicare and your IRMA brackets and all of that sort of stuff. But yeah, it is going to reduce your overall tax bill, but it doesn't mean it's going to reduce your income that they use for the other calculations. So that's also important to remember. Just because you're getting these deductions, it doesn't mean your Medicare costs are potentially going to be lower or what have you.
It's called a below the line deduction, so it doesn't affect your adjusted gross income. So that's a very important number because that's what's used to figure IRMA brackets and things of that matter.
And phase outs and all that good stuff.
Yeah, so you guys are trying to get people to leave the podcast talking about above the line and below the line deductions. So, okay, we're not going to go down that road, but you make a very, very, very good point. So, okay, so you have your gross income, your combined income, and then you have certain above the line deductions like IRA contributions and a few other things. And then you get to your adjusted gross income, and then you start to, or your gross income, and then you take other deductions down. So correct, it's not going to impact that. And without going too deep down in the rabbit hole, those numbers, they determine your Medicare premiums, they determine how much tax you pay on Social Security outside of this deduction. There are literally, I think 7 or 8 different modified adjusted gross income calculations in the tax code.
What did
Probably
they say, they're adding like 7 new phase outs or something like that?
Yeah.
It's impossible to do your taxes on your own
Oh,
anymore. Yeah.
I think that's the number one takeaway.
So, well, here's the interesting aspect. With this new bill, in the first Tax Cuts and Jobs Act, there was an intention to make it more simple by increasing the standard deduction and therefore eliminating the need to track expenses and go through that itemization process. But this is actually now, although there's a lot of benefit, a lot more benefit for people in kind of in that middle income to lower income, maybe upper income will go through, or upper middle income will go through some of those ranges.
Lower income?
But it's more complex for sure.
Absolutely. And that's why Troy said at the start of this, we're trying to wrap our head around this because there's just so many different nuances and caveats to every individual tax rule. It takes me back to my CFP days where they're like, okay, here's the law, accept this, except if this, but then accept if this, and
Those multiple choice questions.
Yeah.
they're terrible.
But I also just recognize that when we talk to clients and we start the income and the tax strategy planning, the beginning of the year, the end of the other, previous year, we just say, we're going to have a preliminary analysis, a preliminary plan, but we're going to wait. And then for this exact reason, everything has changed. And so there are potential for Roth conversions or potentially their income plan where we might be taking money out of. That's all important.
Yeah, because so here's the thing in retirement is you have to choose where you're going to take your income from. The retirement account, the non-qualified account. Do you sell stock, which creates capital gains potentially, which increases your income, which then dominoes through to possibly impact the tax on your Social Security and every other aspect of your retirement income and tax plan? So this has created additional layers of complexity into identifying what is the best decision for me to make with my choices.
Right.
So one thing that we should point out, though, is even if you itemize your deductions, we're not calling it the Social Security bonus deduction because even if you don't take Social Security and you're over the age of 65, Ed, you still qualify for this, right?
Still qualify for this, yes.
So you still qualify for this. And even if you itemize your deduction, so let's say because the SALT tax deduction has now been increased from $10,000 to $40,000 as long as you make less than $500,000 a year, no matter if you're single or married filing jointly. If you get up to $600,000 a year, you're completely phased out. And in between $500,000 and $600,000, there's a gradual phase out of your deduction, which just simply means that it reduces your deduction from the $40,000 down to $10,000.
Troy, you lost me. What was the SALT deduction?
Sorry, the state and local income tax deduction.
Okay, thank you.
So point being is that
Has nothing to do with blood pressure. Or cholesterol.
We hear SALT and like, wait, nutrition channel, different channel on YouTube.
The difference between the SALT and we're going to call it, again, the senior bonus deduction, is that the SALT deduction, and we'll transition there next, but the SALT deduction, is not available if you take the standard deduction, but the senior bonus deduction, if you take, I know this is getting complex, but bear with me. We're trying to make this as simple as possible.
Remember, the tax code is simple.
Yes.
Yes.
All 95,000 pages of it or so.
Yeah.
But if you do itemize, and where I was going with this is because you now are going to take advantage of the SALT deduction, the state and local income tax, you can still take advantage of the senior bonus deduction. And I'm not trying to be offensive here to anyone 65 because I know right now we have a lot of clients
We
who
have
are
a lot
65.
of people here getting there.
They still feel like they're 30, 35, 40, obviously with some things here and there. But the point being is we're going through this all together as far as figuring out what this possibly does for our income tax situation, our planning decisions. And it's important to point out that even if you itemize your deductions, you still can take advantage of the senior bonus deduction for the Social Security if you're over the age of 65.
Correct. I think I heard it best on one of the sources that I look at when I was first trying to, if you will, get organized on what these changes meant for our clients. And one person, not to get too far in the weeds, called it a below the line deduction. Because whether you're itemizing or taking the standard deduction, these...
That's a CPA joke.
Yes.
Not many people are going to get
And he
that.
was a CPA, as a matter of fact. Good call, Troy. But I mean, there's another one that we won't probably go too much into, but that's the deduction on car finance charges. That's a below the line deduction. You can take the standard deduction, you can do the itemization, but you can still take advantage of this.
But the main thing there, though, with that specific deduction, the senior deduction, is that income limit's only $75,000 per person, and then it starts to phase out.
Starts to phase out.
So married couple, you get $150,000. So you're still limited to how much income you can realize in order to claim that deduction, but it's still going to be pretty powerful for a lot of the average American.
Yeah, so
For the
the
average.
majority of Americans in this country receiving Social Security is their primary source of income, if not their only source of income. So this is where I said earlier, where there are facets of this bill that are weighed far more heavily towards helping the kind of middle income to lower income people. Not the super low income, because those people, their Social Security is already tax-free. So you do need some source of income in order for you to be even facing taxes whatsoever. But if you're in that kind of middle income to lower middle income range of retirement, there's a very good chance that this additional deduction, $6,000 per spouse, could really help you save a lot less in taxes. But for a lot of our clients that do have significant assets accumulated or significant sources of income, it's fairly nominal. It's not really worth spending a lot of time strategizing or planning over. The bigger one would be the SALT. And we'll talk about that in just a minute. But to clarify your point, Nicole, so when you think of phase outs, you've heard us talk about this word phase out. We've talked about it a couple of times now. All a phase out means it's a means testing, right? So if you followed us for a long time, you know that we've talked about means testing when it comes to the potential insolvency of the Social Security trust fund, and I think it's about 8 years now. Means testing means if you make a certain level of income, you receive less benefit. So a phase out just simply means that once you reach a certain level of income, you start to receive less of that deduction. So in the not going to call it the Social Security.
Yes, you are.
Because,
Stuck on
again,
him.
because you don't have to be receiving Social Security to receive this deduction. You just have to be 65. So we should call it the age 65 deduction.
But there is
Yeah.
already an age
We're
65
workshopping
deduction.
this.
There's
If you
another one.
guys,
So
if
it's a
anyone
bonus.
has an idea, hit it in there. What should we call it? It's not a Social Security deduction. We don't like senior deduction.
While we're on it, though, Nicole, we did get a couple of calls, and I think some people might be interested to know about the email that we received in
yes.
regards to immediately. Ed, I think you received it as well. I can't
did.
remember. Was it evening of July 4th or evening of July 5th?
yeah, it was right
Social
after.
Security was really quick to just brag about your Social
We did
Security.
it. We made your Social Security tax free.
Yes, and so
they did it.
I'd love to take the opportunity to clarify what was that email about.
Yeah, no, they
Because it's not that your Social Security taxation was changed at all.
and to add this, not a credit. This deduction is only around for what, this year and 3
4
more
years.
years.
The
So
Trump
4
years.
years.
4 years.
Yeah,
The Trump
so
years.
just for the duration of Trump's presidency, and then
Correct.
who knows? We'll see.
We'll
if it'll
see.
continue after that. But it's just for a limited time deduction type thing.
Yeah, so we could all just delete that email and just move on.
So
Yeah,
it doesn't change the way that your Social Security is
Correct.
taxed or the
Correct.
computation of that number. It just creates an income tax deduction once you've computed all those numbers to help some people pay less tax. And others, it may not help at all. So the phase out part that I was discussing for those of you who it will not help or will not impact, once you get to, so it's 75,000 for single, 150,000 for married filing jointly. Once you get to that level, you start to see that benefit reduced. And once you get to 175 if you're single and 250 if you're married, that benefit completely goes away. So the deduction for being wise and experienced, we'll call it, as opposed to
So
the
wise
Social
and
Security
experienced
or
deduction.
senior deduction.
I like it.
It goes away. 175 for single, 250 for married filing jointly. So again, it is tilted towards the middle income, the lower middle income side of the spectrum, but at the same time, it's still, I think, what do we see, Ed? What did we read? I think it was, I don't know who to give credit to for the source, but this will help get Americans, I believe, 88%
About 88% will
of
be
Social
affected by
Security
this, to where that
recipients.
looks, based on the calculation, bottom line, that now their Social Security is tax-free.
Yeah.
If you look at it a certain way. Perception is reality.
Perception is reality. And what you're talking about there is I assume, I'm taking a guess here just based on my knowledge, if you isolate Social Security in a vacuum and then apply the Social Security taxation laws and the new deduction without considering everyone's
Anything
additional
else, right.
potential income sources. So
To translate that, could we say that about 88% of individuals are living off their Social Security, so that is their income, of which only half is considered in their taxable income. But then we have to look at the other individuals that are either have a pension or they are taking money out of their IRA because they're having
Required minimum distribution.
required minimum distributions, because guess what? They saved during their working years and they have more of an enhanced lifestyle during their retirement years. So that's where they're coming up with the 88%, is that a large amount of Americans are just living off of Social Security, but that's not the norm if you're probably listening into this program.
So I need to catch up on some questions here.
Ed?
Yeah,
Ready?
Edward. Well, no, we actually have a question from Edward Alper.
Oh, hey, Ed, how you doing? Good to see you.
Ed, how you doing, man? It's been some time. So, simple question though. In sense of the complexity of this bill, do clothing or charitable donations play into the standard deduction with the new rules? So, no. So you would either take your standard deduction or itemize your deductions. But
But there's more.
There's more.
But wait,
There's more.
There's more.
Nicole,
Don't
we
even.
were talking about this
We
before
were.
and going back and forth on this because it's pretty exciting. I'll
Well,
let you take it.
there's multiple ways you can take a charitable deduction. Now we're going back to above the line, below the line. There's an above the line deduction that you can take of up to, what is it, $1,000?
Single,
Or
1,000,
single,
2,000
2,000
married.
filing
Married,
jointly.
thank you. So then that's
Teamwork.
just off the top. And then the rest has to coincide with your other itemized deductions. But starting next year, there is going to be a reduction of how much you're able to deduct of your charitable contributions of 0.5% of your AGI. Will come off the top of your charitable deduction that's allowed to be deducted as part of your itemized deductions. How many times can I say deduction in 60 seconds? Tiny.
So,
Just kidding.
so ultimately, it's not going to impact 99.99% of you watching, because 0.5% elimination of that deduction on 100,000 is what $500 bucks. So if you donate 100,000, you're going to lose out on $500. That's really targeted towards those people who are donating 5 million, 10 million, 20 million. But still, even to them, it's a very nominal impact.
Yeah.
But another layer of complexity as
Complexity.
far as computing and looking at things.
Yeah. There's other separate deductions you can take. I believe this one's above the line for qualified scholarship funds. Well, I think it's
Yeah.
$1,200 that you can deduct off the top.
Yeah.
That's a different type of charitable deduction, and it has to be a qualified scholarship. So there's a lot of fine print to read through as well if you're looking for these opportunities to make sure that you're giving your money to the right organization.
And I guess this is a good time to point out from a disclosure standpoint that while we are all certified financial planner professionals, we are not CPAs.
Correct.
So what we are doing here is taking our understanding and what we've learned from this new tax bill and applying it to a tax planning perspective, which is our responsibility, which is our job, to your retirement. So, we have a lot of clients that donate to charity. We have a lot of clients that say, Troy, I'm not going to donate to charity, and that's fine. It's your call. If you choose to donate to charity, there are a lot of strategies out there that we can leverage to help you save a lot of money over time and the immediate right now. But it's a planning
People ask all the
discussion.
time, how can I help pay for my kids' college education? Well, you can't specify what student scholarship you want to put this money toward. I guarantee you that. But if you want to at least put money toward a student's scholarship or a student's education, you can do that, but you can't specify which student. Otherwise, same rules apply.
Okay, so we have our first raffle.
Okay.
Now, for those of you who...
Susan!
Okay, Susan Williams. You are now
Sorry, I gave it away.
So,
Troy announced the winner.
Patrick, my most favorite intern, only because he's the most awesome out there in the whole entire big wide world.
He came back after last year.
He's
he
blushing
loves us.
back over there.
Yes.
So he held the sign up that said Susan Williams. So Susan Williams, you are the winner of our raffle. Nicole, do you want to talk to Susan for a minute?
Hi, Susan. How's it going?
Is there anything that we need to mention about a special treat if you continue to watch our whole live
There you
stream
go.
today?
So there is a second raffle, and the second raffle, same as the first, will be for a gift card to your favorite restaurant, $100. But in order to receive the opportunity to win this gift card, you have to register. So there should be a QR code on your screen. Scan that, sign up. You're going to receive one thing specifically, which is going to be a tax guide to this new tax legislation that has recently passed and help you understand how it may impact you in your retirement. Once you do that, you're going to be registered for our second raffle, which Nicole will so eloquently announce prior to me getting the chance to finish my thought.
What about this? What about the sweeter treat if you do stay for the full live stream?
I don't know, Janice, you got to tell me what that is.
What is that?
Oh, okay. So yes.
I
So we have a
remember.
special
Right.
guest coming at the
We have
end
a
of
special
tonight's
guest,
live stream.
yes.
So
Thank
never been on the live stream before. and as a
Don't
matter-
ask him tax questions.
Do not ask him tax questions.
He will not be able to answer them.
He
He's
will
a
not.
good tax write-off.
He's a good tax write-up.
Oh, we could segue that into Trump accounts.
Yep.
Yeah.
So we're going to bring Baby Jack up here. So I know we have a lot of clients on here. We have a lot of people who maybe are not clients, considering to be clients, or people who are just tuning in. So I have a 1-year-old son. His birthday is actually this Thursday. He'll turn 1. So my wife is going to bring Baby Jack up here, and we're going to introduce Jack to the live stream.
YouTuber.
He's probably going to touch the microphone and try to touch the camera, and if anything breaks, it's
It's
Eric, I'm
insured.
It's on
sorry.
Dad.
Right?
It's on Dad.
I guess I'll pay for it anyway.
Yeah. Sorry, I'm just excited about this.
So Jack will be here. We'll see how that
we
turns
had
out.
to
Okay.
make sure Janice stuck around.
Okay, so the SALT deduction, and I want to specifically talk about the SALT deduction, Janice, as it pertains to accelerating income and potentially doing Roth conversions. Because here in Texas, we don't have a state income tax, but we do have high property taxes.
We do. You have one or the other, really.
Yeah. So a lot of people have been taking the standard deduction, but they are paying, maybe $30,000 a year in property taxes. They have some maybe mortgage interest. They have possibly some charitable contributions. And now all of a sudden, because of the increase in the SALT cap, the state and local deduction, sales tax applies to this as well. So if you make large purchases, that sales tax, it's state and local. So now all of a sudden you may be getting up to where you're at $40,000, $50,000, $60,000 of deductions,
Right.
whereas previously you weren't at that level.
You were capped.
So it's a consideration. This is one that benefits higher income people, middle to higher, and definitely higher earning up to a certain extent. It phases out, goes away entirely at $600,000 of income, whether you're married or single, and starts to reduce at $500,000 of income But there are some people who could benefit from this and actually do
Yeah.
Roth conversions now and pay less in tax
Yep. No,
than they would have
absolutely.
otherwise.
And this is going to apply to some of the individuals that are doing some consulting work. So maybe you just retired a year or two ago, but you still want to keep your mind busy. I mean, everybody's talking about mental health and how you should continue to keep your mind busy, but make your own hours, have your own flexibility. So if you are self-employed and have some additional income where you might be able to have some additional write-offs, the standard deduction might not be the best for you. You might be able to itemize now, which will allow you to possibly, when you're doing your tax and income planning, give you more room to do some more Roth conversions. So it's something we don't want to ignore, because we're going from $10,000 on the cap up to $40,000. That's a lot, and definitely will leave you room to be more strategic.
Yeah, specifically those people who are working and now they have certain levels of income.
Right.
Let's say you're making $250 in a consulting role after retirement, but you also want to do retirement planning, right? You also want to do some tax planning.
Yep.
You could do maybe another 100, 150, 200,000 of Roth conversions
Right.
while still being able to deduct those state and local income taxes, because
Exactly.
you're not being phased out until you get to $500,000 of income. And even at that point, Ed, it's 6%, I believe. The
On the
reduction,
salt?
yeah, I believe it's every
30%.
30%
30%.
for every
$30 for
dollar
every 100.
above that. So 30 cents on every dollar, $30 for every 100. Ultimately, all that means is once you get to 600,000, there's no more benefit for you from the state and local tax deduction.
Yeah, I can remember doing some of my own taxes and looking at being able to take our property taxes. I live in the suburbs outside of Houston, so my property taxes are significantly higher. So that was heartbreak 4 years ago when they stripped or put the cap of 10,000. That immediately took away your retail taxes as well, and local taxes. So we're fortunate enough here in Texas not to have that state income tax. For those people that do have a state income tax, perhaps now you need to not say, I'm just taking the standard. You might need to itemize, and that's okay, because with all these options, all these new deductions, you're going to want to seek some type of either software or a professional to help you to make sure you're getting every deduction that you can.
Yeah, and I want to point out the difference here, because ultimately you need to see a CPA. So a CPA is who you need to talk to. But what we're discussing here is how do we integrate those decisions that you're making from this actionable year to benefit you and impact you long term. So how are we tying this into how much money you have in your retirement accounts based on how much you want to spend? Because once you get to a required distribution age at 73 or 75, you have these large distributions, and you may have this potential large ticking tax time bomb in the future. So maybe we shift course right now. Maybe as the captain of this ship, we say, you know what, we were navigating here, but I see this kind of economic storm, this potential tax storm on the horizon. So maybe we want to shift course and go this different direction. So we work with your CPA and we work with you to help decide from a financial planning perspective, how do we make the best decisions possible with all of these people on board to help you save money and make more over time. Because even though they say these things are permanent, they're only permanent until the next Congress comes in
I
and
hate that word.
changes it.
When people use permanent to describe the tax code, it's like, I'm sorry, how long have you lived in this country? How long have you ever known a tax code to be permanent, right? It's going to change eventually. The only thing is there's just no written deadline right now. It
Right
could
now.
change right now.
Another thing is, fortunately they passed this tax legislation for us to consider July 4th. So we're almost in August. This week it'll be August. Whatever action you're going to take, you got to do it before the end of the year. So I know we're working closely on the...
If you're going to buy an electric vehicle, your deadline's even shorter. That's my favorite one.
That is true. I think this is actually the real reason for the President Trump and Elon Musk tiff is the
you want that Tesla
electric
truck.
vehicle credits that have been stripped away from this new tax bill. That's conjecture. I'm just making that up, but I wouldn't be surprised if that was
Take it
correct.
for what it's worth as far as truth.
So, okay, Nicole, you're sitting with clients, 3, 4 a day. You're doing tons of planning when you're not sitting with clients. What are some of the biggest questions or concerns that you're seeing on a daily basis regarding this new legislation?
It's still kind of coming down to how do we make sure that required minimum distributions are under control, right? And does it make sense, even though there might be more tax credits if, like, we stay under that $150,000 income line or what have you? We still want to look at what's the long-term ramifications here, and can we still have an impact by doing Roth conversions or just having a distribution strategy that involves taking IRA funds now rather than delaying them until we're absolutely forced to take that money out, just so that we have more control over what tax bracket that we're in, and we're creating Roth funds that will continue to grow and still give us options down the road to help keep our income down, potentially, if we're smart and strategic enough about it.
Okay, so I have to close these polls because they pop up on my end as well. So coming back up these questions, guys, we're gonna again we want your comments, we want your questions. I'm gonna go back up and kind of address some of the things that have been put here to this point so far. And just as a reminder, we are going to have one more raffle at the end of tonight's show. You should see a QR screen periodically show up throughout the night.
Sorry.
Show up throughout the night on your screen. And when you do, if you scan that QR code, you have the opportunity to register for our tax guide to this new tax bill. And when you do that, you will register for an opportunity to win a $100 gift card to your favorite restaurant. So, coming back here. So, Just a Guy says OT deduction important for me. So, overtime. Yes. So, overtime, taxes on tips, the car loan interest deduction.
The overtime thing, it's very important to note, it's only on the amount above your base pay. So, you don't get all those overtime hours are not deducted.
The definition of overtime?
No, but it's not the base plus the overtime pay. It's just the overtime pay.
So if you're
so
making
you're getting like time and a half, you're only not taxed on the half.
Yeah, that's
you're
overtime.
Still taxed on the time.
That's overtime.
Even though it's over 40 hours. That's all I'm saying.
That's overtime.
Mm-hmm.
But I just
I'm
wanted to
with
clarify.
you, Nicole.
Thank
I am
you.
with you.
Thank you.
So it's not time, it's only overtime.
Overtime dollars
Yep.
above your base hourly pay.
I don't like how this is going.
No, you're being attacked, and I'm trying to.
No.
Thanks, Janice.
I thought you were. I thought I was about to learn something new, and then
And
I
then
did
you
not.
were just redundant, and you didn't say anything worthwhile.
Why don't we go down a real rabbit hole? Why don't we start talking about the new gambling limitations on losses?
no.
Okay,
Well-
so this is big now because look,
It depends on who you are.
Look who's starting to lobby for the elimination of this. So for those of you who don't know, there's a gambling provision in this new tax legislation. And guess who is now pro-gambling? Major League Baseball, the NBA, and the biggest dog of them all, the National Football League. So there are gambling limitations in here, which we're starting to see a lot of lobbying efforts. And not to get into politics here because we don't do that, but you're seeing it. Like there's a lot of people, powerful people, who do not like the new gambling aspects of this law.
I heard about a lot of pressure being put on when you were able to deduct 100% of your losses down to 90% of your losses. I don't care about that. I mean, for our clients, I feel like that's not really a big concern. But
No.
boy,
Only
did
up
it
to your
ruffle
winnings.
feathers.
Right.
I've got one client.
You don't get a claim.
They're not going to be
a
happy about
loss.
this.
Well, the reason why it's interesting, I'd say, at least for me, is because gambling is so when we think about it from an investment standpoint, right? A lot of times we're looking for asymmetrical risk return opportunities. So if I invest $1, is there a potential for 1.9 or 1.8 or 1.7 or 2.3 for return? When you increase the tax on certain decisions that you make to deploy capital, it creates a more negative potential outcome when you look at after taxes. So it's just interesting from the standpoint of the huge, powerful players in this country. And you're talking about the NFL, right? That's the real big dog. They don't like it because they're making hundreds, maybe I should say tens of billions of dollars.
They're making money
On legalized gambling. So it's just interesting, but obviously not pertinent to tonight's discussion, other than just the
We went down the
curiosity.
rabbit
that it
hole
brings.
anyway.
My brain went to slots, so clearly I am out of the gambling league.
Yeah.
I am not a gambler.
Okay,
me neither.
so coming down here, so the overtime deduction, the taxes on tips. Again, so these things aren't necessarily important to our clients. They may be important to your children or grandchildren. But look, this is another aspect of the bill that is tilted towards the middle income,
class.
the lower income, not the low income, because those people already aren't paying taxes. But these are things that are going to put more money in people's pockets. They're just not going to affect a lot of our clients. So we're not going to spend a lot of time on them tonight.
They had to keep everybody
the funny
happy.
thing
to
is,
get
they
these
think
put through.
people were paying taxes on tips in the first place. Jokes on them.
Well, so Patrick, our intern, we just had this
I
discussion
have
the other
never
day.
once tipped Patrick. I can tell you that.
No, but many people now are running, are they not, Patrick, running tips through the POS system?
Yeah. Well, that's the reason they are doing it.
You
now.
actually, what do you have to
You
do
don't
with
have
your
to hide 'em
tips?
anymore.
You told me you take your tips, cash tips, and you actually have to report them to them. They get distributed across everyone. And then from the POS system or the payroll system, you get a check, and now you have to pay tax on those cash tips. That's garbage.
You need to find
Yeah,
another job.
Respectfully. But yeah,
Another paid
waiters,
job.
waitresses. But then again, like
Yeah.
back when I was a
No, it's
waiter, back
absolutely
when I
gonna
was
help
doing
them.
that, we wouldn't report it, of course.
That's what I'm saying.
It was so small.
No one's
But
reporting
we would
their
tip everyone
taxes.
out. We would tip the bartenders.
Or tips.
Well, maybe not the tips, but we tipped the kitchen. We tipped the bus boys, the bus girls. Politically correct there.
bus person.
A bus person.
And that's
yeah.
why it's still good to have some cash on hand,
Yeah,
so
no.
you can
I-
still treat.
I was a hairstylist for a long time. I'm not afraid to say it. And yeah, I didn't always claim my tips. I'm not counting them every day. I'm using them to pay for my lunch that same day. I'm not keeping track of that.
I have the tip jar out at home, and it doesn't even
I mean,
jingle.
past statute of limitations. You can't come after me, IRS.
yeah.
Okay, so Scott,
Moms can't make anything.
the name here is Scott
Dare
Paul.
them.
Just want
Okay,
to make
we got
sure.
a question for you, Ed.
So I maybe there's a typo here. So is the name is Scott Paul. Scott, I believe.
Hi, Scott.
Is it Scott? Scott, maybe you could clarify down here. I hope I catch up to be able to get the clarification. He says, being 58 and a spouse of 62 years.
60-year-old.
spouse is
Oh,
62
spouse.
years old?
I thought you were married for 62 years.
No.
But he's only 58.
Yes.
Impressive.
Do the math, Troy.
That's where I was struggling.
That's why we work as a team here at Oak Harvest.
How does the BBB impact
Better
our
Business Bureau.
So yes, so we had a joke beforehand, which we thought internally was very funny. But the big beautiful bill impact our plan going forward. Are there additional steps we should be considering now, or hold the course? Scott, it's just going to come down to your plan. It's going to come down to your income. It's going to come down to your objectives, and modeling those. We call it kind of a sensitivity analysis. Good scenario, medium, not so good. Looking at all of your potential decisions and choices and objectives, goals, income, different scenarios, and then seeing what makes the most sense today to benefit you long term.
I think it's all great news. One thing that we've been doing over the past couple of years is we've had the urgency to encourage people to do those Roth conversions, because at the end of this year, current tax brackets, they were going to be running out of our favor. So there was an urgency for individuals to be able to go ahead and do those Roth conversions. But now we have a little bit more of breathing room, another 4 years. We know with the tax brackets, they say they're permanent, but Nicole does not like permanent.
I do not.
But we have a little bit more breathing room.
Yeah, so it doesn't mean Roth conversions no longer make sense. It just means we can be a lot more methodical about it. We're not trying to rush to beat any kind of clock, but we still want to make sure we're taking advantage of these lower tax rates because they're as permanent as we're going to get, so we still want to take advantage of them.
So 2 things we're going to do in a few minutes. We're going to do the raffle. And if you have not registered, you do have the opportunity to register for a $100 gift card to your favorite restaurant. QR code on your screen. Register for the raffle. We're going to do that in about 10 minutes, maybe 7, 8, probably closer to 12 or 15. Just a Guy brings up a really good point here. And so this comes down to like the words we use and the words we choose to use to communicate a point. So Ed, we've talked about this a lot. When someone pays taxes on Social Security, those taxes are then used to help fund Social Security, right? So Just a Guy says going back, this is something I talked about 20 minutes ago. If this does not affect, meaning the Social Security deduction, if this does not affect Social Security taxation, then why am I saying, or they saying, it will deplete the trust fund a year earlier? So because we're now putting, according to their math, again, we're talking about academics, right? We're not talking about,
Actuarials.
real world people. I guess I say that in jest, or maybe comes across as derogatory. It's not what it's meant, but it's, academics, they take a problem and they isolate it and they do the analysis and then they present their findings. When we say that now 88% of people who receive Social Security are not going to pay any income tax, you can pretty clearly see how now all of a sudden we may have a quicker point of the shortfall in Social Security and the trust fund.
That's exactly correct. That's the latest numbers that came out from the sources that provide that information to us. And that is, not only was it that, but also, not to get off key, but off track, but also the Social Security Fairness Act that was passed. I'm not saying it's bad, I'm not saying it's good, but it's accelerating the depletion of the Social Security trust fund.
This is the double whammy, honestly, to the Social Security trust fund. So Nicole, you worked for the state retirement system, city retirement system for many years, and you've dealt with a lot of questions as it comes to people's pension benefits, retirement benefits, the impact on Social Security. So when we talk about a double whammy, President Biden passed the Social Security Fairness Act, which allowed people who were previously not qualified to receive Social Security benefits to now receive Social Security benefits.
100%.
This law takes people who were paying taxes into the Social Security system, and now a good number of them are no longer paying taxes into the system. What are you telling clients when you talk to them about the solvency of Social Security long term?
The Social Security that those people who weren't previously eligible to receive it, and now they are due to the elimination of the windfall elimination provision, they're not getting Social Security benefits based on their income that they were making when they weren't paying into Social Security. They're only getting income based on what they paid into the Social Security system. So they're getting what they rightfully paid for and earned, as long as they earned their 40 credits and all of that good stuff. So what was happening before was they were then further reducing that and potentially eliminating that. So they were kind of getting hit twice. Yeah, we weren't paying into Social Security, so you don't get credit for those years you didn't pay in, but they were also taking away the years you did pay in. And they just got rid of that. And so to me, I'm kind of pro that act. I'm like, they earned it. They paid into the Social Security fund. They should get something back out. But yeah, it is going to deplete the Social Security funds much more quickly.
It will put a strain.
Yeah.
It will put a
But
strain.
we've known that there's problems with the Social Security funds for how long? And nobody's really done anything
And they're not gonna
super
address it.
impactful to fix it.
Not till the very last minute.
Yeah.
So thinking of the current law, current tax legislation that was passed, the only one that really comes to mind is the qualified business, the QBI, that reduces some of that outside self-employment income where you don't have to pay that Social Security extra tax. So that portion is continued to be reduced. I don't know if there's really anything else in this law that's going to reduce how much is going into Social Security.
Well, it's just this portion that the people that are now not paying taxes on Social Security that previously were, that delta is not going into the Social Security fund. And I don't think it's $1 trillion, but Ed, what are they projecting now? It's another
like a
6
year
months
earlier.
or
Like
year?
6 months. Another
6 months or
on
so.
top of the roughly year, I would say, the Social Security Fairness Act as far as the strain.
Yeah, but it's a good point. Very good point, Janice. But again, we're talking. I mean, I hate to say hundreds of billions of dollars is a small percentage of the overall
It's all relative.
problem. But at the same time, look, they're going to address it at some point, and we've said this. We think it's going to be means testing. At least I do. I don't think there's many people out there that probably disagree because politically, it's far more palatable to say we're going to reduce the benefits of those making $500,000 a year, $250,000, as opposed to those only making $40,000 or $50,000 or $60,000 a year. It's a pretty clear political strategy. If I was in office and I knew this can was kind of sitting there down the road that I either had to kick or address. So that's where the tax planning, the income planning, that's for a lot of you, like many of you who are clients, you get this because we've talked to you about this. Some of you just tuning in, you have no idea the tax infestation and the potential time bomb that you have in your retirement account down the road, because if you don't address that problem, if you don't handle those required minimum distributions by being proactive today and taking active steps towards minimizing your long-term tax obligation, what type of problem they may be in down the road.
That's what the government's hoping they do.
Yeah.
And that is nothing.
There is a government plan, right?
Yeah.
Do
There's-
nothing. Please
Doing
do
nothing
nothing.
is also a decision. Yeah.
Literally, like when we talk about, we do income planning, tax planning, estate planning. Those are 3 steps of the retirement success plan. Of course, we have investment management, and then we also do healthcare planning, which we are going to talk about, the ACA. If you are prior to the age of 65, if you are younger than 65, there is an impactful component of this legislation that may impact your healthcare premiums if you are on the Affordable Care Act, the Obamacare exchange. But the government has an income plan for you with required minimum distributions. You are forced to distribute that money. They have a tax plan.
Unless
whatever-
unless you're strategic.
Well, no,
and
no, this
plan
is the
ahead.
government's plan, right?
Yeah.
This is the government's plan.
But then Nicole has a plan. We have a plan.
This is the income plan is required minimum distributions. The tax
Mm-hmm.
plan is, hey, whatever tax rates are at that time. And then the
Mm-hmm.
estate plan is when you die, your kids have to fully take that money out within 10 years. And then whatever the tax rates are at that time, pay the federal level. And if you're in a state, if you're watching this in Massachusetts or California or New York or New Jersey or Illinois or any state that has a large state tax, you add that levy on top of the federal income tax obligation. Now all of a sudden you're looking at 45, 50, 55, maybe 60%. I mean, right now, under this legislation, the tax brackets and the tax rates are, at least maybe not the tax rates, but the tax brackets, the buckets.
Very wide.
They are very
They're big
wide
buckets.
or large. You can take
Deep.
large sums of
Big,
money.
deep buckets.
You can take large sums of money and not pay income taxes. When that changes, and it will change because this is not permanent, if you have this problem down the road, you could be in for a big challenge.
I'll elaborate further because it's a very general statement to say, but if the average, let's say, person lives to their, let's say, their 80s, by the time they pass away, if they have these large accounts that they pass over to their beneficiaries, usually their kids, by that time the kids are possibly in their 50s or something in their higher earning years. And these required minimum distributions will go on top of their income. And that will have a domino effect as far as pushing them into higher brackets. There's other things regarding that. Again, I'm not going to go down that rabbit hole, but it does have a domino effect. And so it's not necessarily the most efficient plan, which is what the government's hoping you'll do.
So, Barbara, maybe you are still here. I hope you're still here. She said, is the phase outs, is that based on adjusted gross income or taxable income?
Which phase out are you talking about?
Are
They're
they
all
not
different.
Are any of them based on taxable income?
They're normally AGI or
Normally
modified
AGI.
AGI.
Or modified
or
AGI.
Some
Modified
form
adjusted.
of modified AGI.
Yeah. So not taxable income, like 93% certain on that. Again, talk to your CPA, but based on our recollection and just understanding of the tax law in general, when you have phase outs, they're typically based on either adjusted gross income, possibly modified adjusted gross income, but not taxable income. Taxable income honestly wouldn't make sense just because different people would qualify for different things to bring them to a differing level of taxable income. But good question, Barbara. It's really important to understand, especially if you're a
Differentiate.
self-director and you're doing your own taxes, you're doing your own planning. That's a very big question, but I do encourage you to talk to a CPA for that. Okay.
To review the 1,000 pages of new tax.
I mean, we've attended and
legislation.
listened to, read several articles, attended webinars about all of these different changes and adjustments to the tax code, and every single one of them says rely on the software because it's almost impossible to remember
Yeah.
all of this stuff.
And I think that is so. I mean, geez, I don't know. I probably, as CEO and owner of Oak Harvest Financial Group, I think I spend close to $250,000 a year just on software.
Don't look at me when you say that.
I'm looking at you because I buy one particular software every single year just for Nicole because she has like 3 clients that really like
I
it.
backed her
Three.
up on that.
There are more
too.
than 3.
Yes, it was
But-
important
but
to us.
It's a great point because look, as human beings, we can read the tax law, we can apply it, but if we're not taking technology to our advantage and more importantly to your advantage, and geez, we have so many different technologies and softwares and you have to use them. There is no one perfect software.
No,
there is
there's
no
not.
one perfect technology.
There's
that
no
just
one perfect
takes-
person of
Like
us.
I laugh
Speak for
sometimes
yourself.
and I don't want to offend anyone here, but it literally is hilarious if I talk to someone and they say, Troy, you know, I just threw into ChatGPT,
ChatGPT.
and it gave me an answer.
Yeah.
I'm like, yeah, I gave you an answer. But good luck with that, bud.
But is it the right answer?
I like the example you give because I hear that a lot from prospective clients that I first meet with. Saw the videos, really like the idea of Roth conversions. I'm already doing Roth conversions on my own. Simple question, tell me more. And I'll use simplistic math here to make my point. Well, yeah, I did a $10,000 one last year. Good. How did you
10,000?
come up with that number? Well, and they'll give the reason. And then I'll ask the question, and you've had this conversation as well. You know, what are your IRAs, approximately your pre-tax IRAs worth? About $1 million. Okay, so you converted 1% of your assets.
Yeah, how much did you grow this
How
past
much
year?
how much did your portfolio grow? Oh, 8%.
Yeah, so how much of that problem do you think you actually solved?
Yeah.
-7. So, yeah.
Yeah. Yeah.
Good at math.
Thank you. Thank you.
And like, I don't want to diminish ChatGPT because look, you know, we use a lot of AI in many different aspects of the firm, and we're trying to learn more of how to incorporate it to improve efficiency and productivity and improve process. But at the same time, ChatGPT or any of these AI models, there's a reason why
There's
I
no
spend
nuance.
$250,000 on various technologies because you need a certain programming in order to run, to be able to have the input fields, to put the variables in, and then create a sensitivity analysis on those variables, and then run analysis across hundreds of different variables to create some type of probability output. When you just enter something into a basic artificial intelligence model, you don't have that control. Maybe you did if you understood all of the different variables and you created a structured prompt where you could.
And if you do, please create us a software
and
that is
if you
perfect.
could, I'll pay you, $200,000 a year if you could do that.
Absolutely.
Okay, so I want to move on to the Affordable Care Act, but I got some people over here telling me that we have a new raffle winner. So
John Fredericks. Sorry, Nicole.
Way to go.
okay, so we have John Fredericks. Janice, do you want to go and tell them what happens? Because we're going to do another raffle in 15 minutes because we are getting towards the end here. But
Are we
do wanna
raffling
wrap
off
it
a
up.
child?
No, we are not raffling.
No.
Out. Is Jack
we
here?
still haven't talked about the Trump
No.
account.
No, Jack.
But unfortunately, Jack is not eligible for the $1,000 government
Jack
contribution.
Is not. So we have 2 more things to
No.
go over here. But Janice, do you want to tell people what they get if they register for the next raffle?
If they register, they get the OBBBB.
Besides dirty looks from Troy.
Brochure. Yeah, it's a couple dirty looks. But
Pretty soon, I will not be the host of this show anymore. I'm just going to obviously pass
Nicole
it
and I
off
will take over.
to
Ed will
my
bump
better
in every now and then.
counterparts, Janice and Nicole.
Yes. We've
But
done
no.
a summary of the legislation, tax rules, and some of the changes, some things that may be more important to individuals that are retirees and so forth. So look out for that. Sign up for that so you can potentially get a $100 gift card to a restaurant of your choice in your area.
That's very good. So there you go, Janice.
Very nice.
Thank you.
Okay, so we're going to do one more raffle in 15 minutes. And as Janice said, you should have a QR code on your screen. And in order to receive the opportunity to earn that $100 or win that $100 for your favorite restaurant, just simply sign up and you'll receive that one big, beautiful bill tax guide to help you make better decisions with your retirement. Okay, let's close this out. The last 15 to 20 minutes here. We have, I think, what may be the most impactful aspect for a lot of people in retirement, and Baby Jack is here.
Jack is
Now we're all
here.
distracted again.
So we have one of the most impactful aspects, which is going to be the Affordable Care Act. So, and then we have the Trump accounts, which is going to be maybe the least impactful. Would you agree?
I would agree.
Let's tackle the Trump accounts first,
Oh,
because Nicole has a
Okay.
big opinion on
I
these.
have very
She's a
strong-
huge fan of these Trump accounts. So, Nicole,
Nicole
tell us
has
all
an
about
opinion?
the benefits of these Trump accounts.
Well, I have very mixed feelings. On the one
Mixed
hand,
in like how? Which way? Like 99%
Because
this
she's
way
not
and 1%
pregnant
this
and
way?
she doesn't have a
3%.
child on the way. But,
yeah, no, it's a great
but-
way to kind of start up a savings account. If you have a child over the next 3 years, in 26, 27, or 28,
Or grandchild.
well, yeah, or a newborn child springs forth in your family.
Yeah.
And you open a Trump account. I'm not sure who they are, but they will put
The government?
$1,000 into that account.
Yes.
And it's all going to grow tax deferred, meaning when that child turns 18, that account now becomes basically an IRA, a tax deferred IRA. And we've been sitting here talking about how do we get money out of those tax deferred, tax infested accounts. So that's kind of where I'm a little conflicted, where it's like, yeah, it's great. You're starting the savings program, but it's all going to be considered technically. I mean, there are some after tax dollars if we get into the weeds, but basically you're just creating a taxable account for your child or grandchild or niece or nephew or whatever. So there's pros and there's cons, but there's pros and cons to basically every account type. And so you just want to make sure you're looking into those pros and cons before you make that decision on where you're going to invest your money.
Ultimately, there's no significant benefit here for people who are middle income, above income, average income range. Look, my fear here is that, look, even on an incremental basis, we have to have concerns when government creates policy that may incentivize bad decisions. And when you start, talking about $1,000, again, I'm getting more into economic philosophy here, but there's not many people who are going to say, you know what, I'm really going to go do this because I'm going to get $1,000. $1,000 isn't a lot of money, but at the same time, the question really becomes, is the Trump account better than the 529?
Yeah.
And that's the real question. What benefit does this Trump account, yes, you do get $1,000, but how
With
much?
compound interest is not nothing. By the
It's-
time you're 59 and a half, which is when
It's-
you can touch it without
it's basically
penalty.
nothing.
Well, you could.
Respectfully,
Yeah. You could
respectfully.
use it for
I mean,
college.
say it doubles every 10 years. You're looking 1 to 2, 2 to 4, 4 to 8, 8 to 16.
How long
Maybe
can
you're
you
looking
go?
at 40,
Keep going.
$50,000.
Yeah. Plus,
okay.
you can add more to
But
it.
when you discount that back to the present value
And after taxes.
and after taxes,
So you got to account for all that.
so it's like
So to me-
$12,000 in 50 years.
For my money, I'm going 529 because after that account is 15 years old, there are some rules. Ed has taken care of the rules area of this whole
I
equation.
didn't write them, but go ahead.
Yes, you did. You wrote them down right here.
Yes, I did. Those
So-
are
They
let's
did
take that
consult you, right?
situation.
Before the
You can-
rules were created. They consulted you, correct?
They
Ed?
did.
Oh, yeah, they gave me a call.
Yeah. So the 529 can be converted to a Roth IRA. There are certain limits. I think it's, what is it, 30?
And
I can't
remind
read
me
your
again.
hand.
35,000?
Remind me again. Those Roth IRAs. What are those?
Those are tax-free investments.
Those are
They
those.
grow tax free.
They grow tax-free. So whatever, I mean, you put the funds into it now. Yes, you pay taxes on it now, but now you're getting compound interest on tax-free money when you pull it out later in retirement after 59 and a half.
If you have anything left after college.
Yeah, but
I've
that's
already-
a good reason to overfund your 529 so that you make room for that conversion later on down the
Yeah,
road,
you
and it
know-
helps your student be
You-
one step
You know
ahead
what
in
they
that
missed?
tax
They missed an
account.
opportunity here. What they should have done, because you are not able to deduct 529 contributions, but the
Correct.
maximum you can put into a 529 is $75,000, or $15,000 a year over, I think, what is that?
5 years.
5 years.
5 years.
They could have increased the contribution limit to the 529 because you're still paying taxes on that income today.
But that wasn't their target audience.
I'm just trying to balance
Yeah.
this out a little bit more. But so okay, we're not going to
Because
get
that
into
is a lot of money
yeah
for 529.
But point being is the 529, and we're going to get into the ACA, the Affordable Care Act, and how it impacts your subsidies in just a minute here.
So if you've been waiting, wait just a
Keep
little
waiting.
longer.
I'm not going to bring Jack up first, but we're gonna get into
It's not
this
good
and then bring
news,
Jack up.
but let's go ahead and spill it.
Yeah, it's not good news.
Hope you're sitting down.
But
Troy, I'll chime in, and that is, I would say I'll play devil's advocate here on these Trump accounts. They're more for a retirement account, if you will. They're not a replacement for the 529. They're not
No.
in competition for them. Also, the $1,000, call that a cherry on top. The idea is to put $1,000, but you're also contributing $5,000 a year. And yes, there's some tax consequences there. And if I were going to go further, maybe down the road, if it's a large enough amount, call Oak Harvest. Now you're doing Roth conversions before you hit RMD age and start converting those funds then, depending upon the tax
But we
bracket.
don't know
But we
if
don't
that
know.
is an allowable thing yet.
Okay, but so I'll play devil's
Trump
advocate
account.
to your devil's advocate. Why can I not find some way to employ my child so he has income and I can contribute to
Exactly.
an IRA in their account,
You can do a custodial IRA or
yeah,
Roth IRA.
or just a custodial IRA, right? So
6 half dozen, because they're going to more than likely, I'll use
No one's
myself
gonna
as
put
an example and stick it in.
$1,000 in a
They're not going to get the $1,000, but they're going to also probably put it, like with my kids who are older now, but when I first started with them, they weren't working, but I was still putting accounts in, just putting them into index funds, something that's just going to appreciate over time. Again, I think in that case it's 6 half dozen. But I think the takeaway here is the Trump account, I would say that's more for retirement. It's got its merits, it's got its considerations.
yeah,
A
so-
grandparent that wants to open an
Potentially.
account.
So
wants to have
let's
something.
say this: the big takeaway with the Trump accounts, talk to your CPA, talk to your financial professional. I was going to say investment advisor, but your investment advisor probably has no idea what a Trump account is. So if you have a retirement planner or a financial planner, talk to them. And there is a big difference there. But there may be some situations where the Trump account makes sense for you. There may be some situations where it does not. Overall,
You have until 2026 to make a decision.
well, I mean, look,
so nothing can be open till then.
yeah, I mean, most of the people watching this, I know to us here, $1,000 government benefit is not enough. I'm still doing the 529 personally. Jack, you're about to meet Jack. He's my 1-year-old son. He's
gonna make
crawling
his
over
own way
here now. He's
upstairs.
ready to go. I'm not opening a Trump account for him, and it's not because of
wouldn't get-
honestly,
you
he's a
wouldn't get
good
the
You wouldn't
question.
get the
Okay, so here's the
$1,000.
'Cause he's
question.
already
So
born.
would I almost do it? So even though I don't really care about $1,000, I mean, respectfully.
Respectfully, I don't
Always
give a
the
crap.
asterisk.
So
Well,
we
I'm saying, would I open a tax-deferred account for him that he can't touch until he's 59 and a
Exactly.
half for just
Exactly.
$1,000? Probably not.
Yeah.
I'm more doing, now granted, that 1,000 is going to be taxable, but the other contributions would be able to be withdrawn pre-tax, pre-59 and a half penalty, which is another aspect we didn't talk about. The earnings would be
There's a lot we
subject to the 10% penalty.
But if a
All right,
529,
let's move on to the ACA because
tax-free.
go
because
for
I
all
think
day.
we could debate this for a very, very long time.
And I know
we
that's
got the
what you all
raffle in
wanna
5
hear.
minutes, by the way, guys. Okay, so actually, I'm going to make that raffle 10 minutes, Patrick, just because I want to go through the ACA for the next 10. We'll do the raffle, and then I'm going to introduce you guys to Baby Jack. So
If he's
Baby
still in a
Jack's
good
the
mood
best
by then.
part of all this.
Baby
so.
Jack.
Okay, so here's where I have a concern, and look, it's not. It's a moral dilemma for me, right? Because I think it's projected 14, 16, 17 million people are going to lose their health coverage because President Trump and the new tax bill did not extend a benefit that was already sunsetting. It was going away, right?
At the end of this year.
So part of one of the tax strategies that we've used for clients over the past few years are enhanced tax credits, or essentially subsidy premium
premium
credits,
tax credits. Mhm.
premium tax credits for Obamacare, for the Affordable Care Act. President Biden passed some legislation to extend them, and part of that legislation said they go away in 2025 at the end of this year. And this new legislation, they didn't cancel them; they just didn't extend them.
They
But
didn't even
the-
address it. It's like crickets in the room.
Well, the reason I think they didn't address it is because they had other priorities where they were like, we have to go one or the other. But it's one of those things to where I look at it, first and foremost, that there's going to be a lot of people now who are not going to have health insurance. But a lot of those people, well,
Well, they're not going to be able to afford it, is the thing. I mean, they can get it, but they're
Cost
it's going
prohibitive.
to
Beyond their
prohibitive.
means.
yeah, it is. And, you know, I was paying for it. You were paying for their health insurance. You were paying for it, and you were paying for it, right? It wasn't just free. It wasn't like they were just getting it out of thin air, right? Everyone here was paying for their health insurance. So, but at the same time, now we have more people who are uninsured. So
And
we
that's-
save money on one end by not paying for their premium credits. Health insurance companies, on the other hand, don't increase costs as much as they would otherwise because those costs would be passed through to us anyways. So it's really one way or the other, we're paying for it. But from a tax planning standpoint, for people in retirement, approaching retirement, for years now, we've been able to help people save thousands and thousands and thousands and thousands of dollars by saying, you know what, we're looking at your overall income and tax plan, and it makes more sense to defer those IRA accounts, which is the opposite of what we do so many times, and start to take money out of those non-IRA accounts because
Not forever, until 65.
Until
It's the
65.
To take
Medicare.
advantage of that
Yeah.
premium tax credit. That could be $20,000-$30,000 a year.
Yeah. So look, the Kaiser Family Foundation says that the average family is going to see about a $700 annual increase. But for many of our clients in or approaching retirement that have higher levels of income relative to the federal poverty limit, you're going to see a 75 to 100, maybe even more than that, increase to your health insurance premiums. So this is a big, big aspect of this tax law. And the number one thing, without getting into, look, the economical, the political, more than we already have, it is imperative that you make good decisions leading into retirement where you save money. Because the only way to get around this is to still qualify for some type of subsidy would be to keep your income
To
levels
limit
low.
your income.
So,
Yeah. I particularly have had a few very interesting cases. One client who's planning on retiring midway next year. So we talked about, she's like, yeah, but Cobra's so expensive. And I'm like, let's not badmouth Cobra right now. I said, because you can have Cobra for 18 months. Your Cobra plan is probably going to be a better plan than your Affordable Care Act plan, especially a bronze or a silver level plan.
Better value,
And
yes.
better value and even probably lower cost. So let's consider writing that out until it doesn't make sense to write that out. You get up to 18 months that you can carry that and you continue to use that. So in their case, if she's retiring mid-year in 2026, she's going to have basically half a year of income still, and she's a pretty high earner. And so it's like, okay, we'll carry Cobra through the end of the year and see what happens in 2027. Maybe they'll have made some adjustments. But it's at least we're addressing that. We're cost-effective choice decision plus life value, quality of life decision behind, are you getting a better healthcare plan or a worse healthcare plan for your money?
what's your thoughts, Ed?
In what sense?
Just of the conversations that
How
you're going to
crazy.
have.
No, I would say everything we've been talking
It's
about.
it's like my wife cooked dinner, pasta.
It's going to be steak, but anyway, or something meat related. No, I would say everything that we've talked about tonight can be summed up in that some of the things you've been mentioning the whole time you're saying that. And no, I didn't fall asleep, even though I look like it.
Even though my eyes were
Even though
rolling
my eyes
in
are
the back
glazed
of my
over.
head.
My eyes were dilated earlier this morning. That's
They
a whole other
were.
conversation for another time. But no, that's what planning is. You were talking about how just 2 years ago we were telling people, hey, 2025 is it. Everything's reverting back to the old tax laws. And then things change. So planning is just changing all the time based on the data that we have.
Look, here's the deal. If you are approaching retirement and you're going to retire before 65, this is extremely consequential to you because where you have money and where you pull it from once you retire will impact your health insurance premiums. So it could look. A year ago, you may have been paying $400 or $500 per month per spouse. Now you might be paying $2,000 per month per spouse. This is a big deal, and it is what it is. So the question is, what are we going to do from a planning perspective? And there are choices. There are options that you have to help reduce the costs. For some of you, you can take advantage of them.
Itemized deductions.
Others, you may not. distributions from retirement accounts, non-retirement accounts, taking advantage of the SALT deduction that has now passed, which could potentially offset those
Maybe.
additional incomes. There's planning. There's a lot of things that need to be done.
It's so
here.
nuanced and it's so individualized, so that when you get these questions about what's the average that it helps somebody,
It's
I have no
It
idea.
is case by case. I think
You
the
need to
biggest thing to
ask.
take away, though, is with all of these changes, particularly for clients that are either in retirement or close to retirement, this is actually, in my opinion, an opportunity. It really is. Maybe you'll save more, maybe you won't. But that's where tax planning really comes in, because these deductions that we spent most of the time at the beginning talking about are around for the next 4 years in 2028. Check that out.
Yeah.
Maybe you can do Roth conversions, and maybe
Yeah.
you get phased out to a certain point on this senior bonus deduction or whatever we want to agree on eventually.
That's a
on this.
lot of what
Yeah,
we
where did we
do.
land
It's a
on that?
balancing act,
It's a
right?
balancing act.
It's a
Right.
balancing act because we have these kind of ever-moving goalposts, essentially, as far as, I say goalposts, I should say boundaries, as far as the range within which we can
Guardrails.
operate.
Corridor.
The goalposts, they're actually the same. They're your objectives, but the boundaries are constantly changing, and we have to decide, are we going to run the ball? Are we going to pass the ball? Are we going to run, then pass? Little play action. We're getting towards football season here, so little play action pass, and maybe a slant over the middle.
All right,
Maybe
Jack, where's
we're going
Jack?
deep.
But
So
I would say the last thing I'll say is that you mentioned it a lot on your radio show. When it comes to these decisions, what are we actually providing? Visibility in your decisions.
that's all it's about, man.
That's
So once I
Education.
realized this, and God, I was 23, 24 years old maybe, when I realized that a lack of visibility was the most detrimental thing to a powerful retirement. And by powerful, I mean you have control.
Yeah.
Right? You know the impact that your decisions are making. And the number one inhibiting factor to a powerful retirement is a lack of visibility. Not knowing
not
what
knowing.
the impact of your decisions is having.
Making decisions in a silo,
Asking
making decisions
questions.
just based on, we've been talking about a lot of math
I
tonight,
read an
based
article,
on, read an
so I'm
article.
gonna do this.
Chat, there were,
ChatGPT told me.
I can't tell you how many times over the years, like someone came in and said, Troy, why'd you guys invest in that stock? You know, I was talking to my neighbor and he was like, oh, that's a dog. I'm like, what's your neighbor
What's
do
your
for a
neighbor do?
living? He's a plumber.
he's a plumber. Yeah.
No offense against plumbers. My wife's dad was a master plumber. Her grandfather was a master plumber. They're not investment experts, right?
Stay in your
Roofers,
lane. Stay in your lane.
You know, doctors.
I wouldn't
Engineers.
I wouldn't ask our chief investment officer, Chris Paris, or Charles Scavone, our director of investments, hey, how do I replace my tub?
No. And if I'm getting
And they
a
don't ask about tax strategies either. I know Chris Paris and Charles, they're watching us now. They're
Hey,
our
Charles.
investment team.
Yeah, I
put-
forget
making
that they
trades.
don't know all that stuff.
But
I mean,
they
they're really
come.
smart, but
Yeah, they
they're
listen
not
to our live
planners.
streams. They come to our lunch and learns. They haven't asked me personally for advice, but they know what they
Jack.
know.
ready, buddy?
Okay, it's time for Jack.
It's about time.
now that he's crying,
All right, we're gonna get Jack
We'll
to stop
announce the
crying.
raffle.
So, all right, go ahead and bring Jack up, baby.
Jack
go ahead and give him
Sharpe.
some candy so
Here we
that
go.
All right, here's
everybody
baby Jack, guys.
welcome.
Oh, now we got some smiles.
Yay! Yay, it's Jack Jack. Hi, baby.
Hi, buddy.
Where's Daddy?
Go to daddy.
How are you? Where's Daddy?
There he is.
1 year old.
There we
he goes
go.
straight to
Right
the
for the
He's
microphone.
mic.
gonna touch the microphone very first
Yeah.
thing. Okay, so Jack.
Oh, wow.
Oh, boy.
Might need
Very
another
strong.
little cushion thing on there.
It is football season.
Okay, Jack. So I want you to say hi to everyone over here on camera. Say hi, everyone. Say hi. Okay, so in about 30 years, we're going to be handing over
The reins.
the discussion of retirement and financial podcasts.
Can't hear you.
Sorry.
Oh,
In about 30 years, we're going to pass over the financial discussions and podcasts and everything that we do here to this guy. Hopefully.
Yeah.
Hopefully.
You know,
Hopefully.
It's 50-50.
After he
We'll
gets his
see.
MBA.
The
and
way
all that
it
good
works,
stuff.
he'll probably want to be his own entrepreneur doing his
He's going to be a
own line of-
professional golfer.
At this point, yeah, either that or a professional wrestler because he's pretty aggressive.
Yeah.
So,
Yeah.
I want to introduce you guys to Jack and get ready to close this out. So we have the raffle coming
All
up.
right, Jack, announce the next winner.
All right. Who's the next winner? Ed, it's your
Use the
turn.
microphone.
It's your turn to steal the thunder, Ed.
Barbara Gobbert? I'm going to say, forgive me if I
Yeah.
said that wrong. Barbara
You
That's why we
nailed
Gobbert.
gave it to you.
You nailed it, Ed.
What a natural.
Is it Gobert?
See,
Gobbert?
now you got me double thinking. Oh, and that's the end of that.
There goes your camera, Eric.
Congratulations, Barbara. You won a $100 gift card to the restaurant of your choice.
Thank you for watching, Barbara.
Enjoy.
Jack has so here's the beauty of a little baby. He has no idea that we're on air.
No.
Not a
No
care in
idea
the
that
world.
thousands of people are going to see this eventually. He's like, I just want my
Thousands.
golf ball.
Yep.
He's like,
Yeah.
"Let me
Okay,
go.
guys,
I'm gonna go play.
I'm going to pass Jack off, and then we're going to close this out in the next 5 minutes,
Okay.
and put some final thoughts on everything that's been discussed tonight.
They can hear you on everything that's been discussed tonight.
Ed, why don't you close it out?
Everything.
Everything.
No, I think the biggest thing,
What's your main
again,
takeaway?
when I have started to see, because our software updated the day after this bill became law.
They did. They
They were
honestly
on
did.
And again, as you had mentioned, there are a lot of considerations to now go into the visibility of decision making when it comes to Roth conversions, income planning, and the like. And so, as I've seen that, again, it's presented opportunities. It's not something to be afraid of. You talk about the ticking tax time bomb. Yes, that is definitely legitimate. But hey, we can do something about that. That's a positive thing.
Right.
So that's the way I view this.
I would say, and just kind of bring it all together again, that don't look at things in a silo. We need to look at the whole picture. How is this choice going to impact this choice? And making sure that you're looking at different aspects of the plan, considering the taxes and the medical expenses, and how is all that going to play out in the long term. Keeping that long-term perspective is probably my key takeaway.
And I mean, continuing to work with your CPA and your financial planner. We're excited about some of these changes personally from our own pocketbooks, right? We're going to pay less in taxes overall. I don't know many people that are going to pay more. So that means there's some considerations, right? What other changes are we going to see down the pipe? I don't know. Let's watch and see, and we'll continue to need some more guidance on how to take advantage and how to optimize our own retirement portfolios overall.
It's a balancing act. It's a balancing act because wide majority of people are going to pay a lot less in taxes. The big beneficiaries are going to be people who own stocks in this country, because we didn't talk about, and we're going to talk about this in next month's live stream, some of the corporate benefits to this tax legislation. So if you own stock, if you have a 401k, if you have retirement accounts, there's a tremendous opportunity here to create a lot more wealth over the coming years. But the people who are going to pay more will be the people that are going to lose health insurance coverage. Now, some of them, are, again, I want to balance a fine line here, because we start to get into political and in other aspects, and that's not my area of expertise. But there have been certain laws passed in the past that have allowed certain people to benefit from government programs, and now they will no longer be able to do that. And they're going to be hurt, right? They're not going to have health insurance coverage. That cost will ultimately be passed on to everyone else through various different aspects. So there's a lot of unknown costs, of course, to every piece. And this is why, look, the one thing I will say, without getting into politics, just running for me in organization, we have 50 employees, 45 people. Every single decision that we make, it ripples through, right? I can't imagine being the government and putting random people in charge of all these different organizations and then passing one piece of legislation and saying, do this. And then just trying to figure out how those different human beings will interact with everyone underneath them, how they will all respond, how they will follow the process, how they will not, the impacts on that, on those people below them. So you come into large problems when you have, big government passing large bills, whether you're Republican or Democrat. So with any large bill passed, there are going to be those problems of organizational follow through and the impact from, many different aspects of that human element. So look, there's a lot of good in here. Of course, with any large government bill, there's a lot of bad. But what I want you to be encouraged about and what I want you to focus on is your own retirement, your ability to take control of what's in front of you and to make good decisions. And whether you reach out to us, if you're not a client, if you are a client, please, you're on the schedule. We'll talk to you soon about this as part of your overall plan. But if you're not a client, talk to your CPA, talk to your advisor. Try to get your CPA and advisor to work together. Try to get all these different components of your retirement working together with what's going on with this new legislation, because the goal is to put more money in your pocket to help you have more income. And the reason you do that is, I think, just to simply spend money comfortably in retirement. I don't want to get into stories, guys, but we've all been through this to where someone retires and they're scared to spend money. They've saved $500,000, $1 million, 1.5, 2, 3, 4, 5, and still scared to spend money.
And we can show them software after software that says, you're good, spend it, yes, please, go. And they still just, it's so hard. It's so hard to break free from that mentality of save. So
if you're a client of ours, come talk to us. If you're not a client of ours and you'd like to, come talk to us. And if you have your own people and you're completely happy, please talk to them. Get everyone on the same page, because this is an opportunity. Winds may change. The direction of the sail may go a different way. But this is an opportunity to gain more control. So I want to thank you very much for tuning into tonight's live stream. And as always, turn into our weekly YouTube videos, the Stock Talk from Chris Paris. And of course, we just thank you for tuning in. So have a very good night, and we look forward to seeing you soon.